And I see that in January of 2015, we had $260,000 in profit, like straight to the bank, free cash flow. That was the year that I just could not raise money. Like, I just couldn't do it.
Hello and welcome to First Money In, a show focused on the extraordinary founders and their very first time ever raising venture capital. My name is Nicole Wishoff, and I am thrilled to bring you our latest episode. Today, we welcome Ilir Sela, founder and CEO of Slice. Slice is the all-in-one platform for independent pizza shops, from enabling digital ordering, point-of-sale functions, and much more. Since launch in 2010, Slice has raised over $100 million from investors like GGV, KKR, and CrossStreet. Join us as we learn more about the founding of Slice, bootstrapping to 40 million in GMV, and powering several thousands of pizza shops across the United States. All right, Ilir, thank you so much for joining us. So let's dive into the founding of the business. You started what was MyPizza back in 2010, so 14 years ago, and I believe bootstrapped it to 40 million in GMV before taking on capital. Walk me through where the business for the idea came from and how you founded the company.
Yeah, thank you so much for hosting me. The idea of the business is to create a third way for independent pizza shops to operate. I started the company because I have a lot of family and friends that own pizza shops, mostly in and around the New York area, of course. My prior business was a franchise company, and so I learned everything about the franchise model. I was also in tech support, and so a lot of family members wanted me to help them with things like websites and online presence. And I realized that the ask was pretty consistent from a lot of them. It took some time to really better understand what was happening in the industry overall. And I realized that operators kind of had two choices when they were ready to launch a shop. One was to become part of a franchise, the opportunity to open up a Domino's or a Papa John's location. Most operators open a business because they have a passion for the craft, or they want to bring something unique to the neighborhood. And so 3 out of 4 people choose the independent path, which is completely alone. It's going about it yourself. And I wanted to create a model that brings the similar benefits to the franchise model to all of the authentic independent shops, at least initially in and around New York, but then eventually it became nationwide. So that was the motivating factor. We led primarily with commerce enablement, digital commerce enablement, because I realized that as online ordering became more of an option for consumers, for the pizza shop, it was a really valuable unlock. It meant that consumers were ordering more food, and it cost the shop a lot less to serve that customer. And so that was the product that we ended up kicking off with.
That's interesting. And you bootstrapped this, right? I'm assuming. Did you even know what venture capital was at this time?
I honestly did not. It's kind of embarrassing to admit, but I it was my second company. I come from a pretty conservative sort of business background mentality, which is you create something of value, and then as I've shared in the past, if that costs you $1, you sell it for 2 or 3, and you do that as many times as possible. I strongly believe that resource constraints create a lot of creativity and build a lot of grit, and that's really how I scaled the business. So from 2010 to 2016 was purely bootstrapped with a relatively small team. That's really all we did.
Were you just self-funding this from the start then and trying to get this thing profitable so that you could pay the few employees that you had?
Yeah, I had sold my prior company, which was a franchise company, sold it to a public company out of the UK, and I used some of the proceeds. We're talking about $50,000 to self-fund this business. And the $50,000 sort of helped me fund the company until the point where we started to really make a decent amount of money, relatively speaking. I want to say by 2014 or so, we were pretty profitable. We were generating about $200,000 a month in revenue, and maybe 100 to 150,000 of that was profit. By 2015, our monthly profit was $250,000. So it sort of started to scale pretty quickly, but it was all bootstrapped, yeah. And it was self-funded.
And was that, so by 2015, 2016, when you went to go raise funding, were you still only offering sort of this e-commerce enablement product offering?
It was the most focused product I could ever explain. It was websites with commerce. Think of it as like a very basic version of what Shopify does for e-commerce brands. We were doing this for local pizza shops.
And how was New York your first market? And were you just going door to door essentially?
Yeah, I mean, I want to say the first 20 or 30 shops were friends and family. And again, there are a lot of friends and family that own pizza shops. And then beyond that, it was just going door to door, trying to figure out different ways of getting in front of shops. Tried to educate shops on the importance of online ordering. It was not really a common thing back then. So that was part of the challenge. But yeah, beyond that, it was a bunch of door to door efforts. And then I want to say within 12 months, ended up hiring a couple of salespeople in Macedonia to cold call shops and get them on board.
Oh, wow. Okay. So by the time you raised capital, walk me through that first round. Did you say, hey, I have a large vision and therefore I want to raise venture money? Like what was sort of the impetus for that?
I should have. I was managing my finances through Excel. So on Excel, I can see what GMV we were managing per month and then what was the revenue and what was the profit. And so I'm opening up this Excel sheet week 1 of February to look at January's numbers, January of 2015. And I see that in January of 2015, we had $260,000 in profit, like straight to the bank, free cash flow. And I realized that, this business was becoming very real and I really wanted to surround myself with people who can help me scale. So February 8th, just a couple of days later, went on Twitter and I tagged the 2 or 3 food tech leaders that I knew and I was connected with on Twitter. One of them is Ilir Sela. He was an early leader at Seamless, then founded a company called Single Platform, successfully sold that to Constant Contact. And he was the only one who replied. And he's like, hey, shoot me a message. And we jumped on a phone. He was like, look, when you get to like 500 pizza shops, give me a call and then we'll figure something out. We're at 2,000 locations. And so he's like, look, come to my office tomorrow. And so what I didn't know was at the time he was at First Round Capital. So I went to First Round Capital's office and that's really how I got introduced to venture. But more importantly, it was the founders of Seamless, Jason Finger, Paul Applebaum, Ilir Sela, Todd Arkey. This is a group of like early Seamless leaders that ended up becoming sort of the first investors. Wow. And for me, it was really more about getting them on board. I didn't need money. We had money. I needed people. I needed a network.
And by that, you mean just because they'd sort of been there, done that, and you really wanted thought partners that knew how to help you scale because it was growing like a weed?
Exactly. It was really just bring experts on board, people who can help me figure out, how to go now from 1 to 10 instead of 0 to 1.
And was that that's essentially a seed round. How much capital did you end up raising?
We ended up raising, I want to say $1 million. I was, through that process, I was introduced to Ben's son at Primary Ventures, which is in New York. Ben and Primary also participated in that. I guess you want to call it a seed round. Mm-hmm. And so it was about $1 million in late 2015, going into 2016.
Got it. And when did you change the name from MyPizza to Slice, or was there a separation of businesses there?
Yeah, so part of that whole process, part of that okay, where do I go now process was not only in terms of, it wasn't just about getting these really talented people on board and getting some capital on board, but it was also, what do we do with this thing? We have this really cool asset starting to make a lot of money, but it's really immature in the way that it's set up. I mean, we didn't even have QuickBooks. It was just sort of a man in a van operation type of, I don't know how else to explain it. It was just me running a business out of Starbucks and we're managing 40 million in GMV. Wow. And so what we did was we basically reincorporated. We wound down the business called MyPizza and we relaunched in 2016. And part of that process was to also look at the brand and look at sort of the overall experience. And one of the early marketing leaders we brought on board, a gentleman named Nick Karat, who was at a company called Plated. He's now the CMO of StockX. And he's the one who came in and he said, hey, is everything on the table? I was like, yes, the whole thing is on the table. If we need to rename, let's rename. And so we officially launched the current version of the business on October of 2016.
That's amazing. So you raised the capital, and I'm assuming the next thought process is, what do I do with this? And you had investors to help you think about that. And I'm assuming help you think about roadmap and how to scale and where to spend the money. What did that look like, and where did you go after the initial product?
This early group behaved less like investors and more like a team. Paul Applebaum, who's awesome, became our interim president. They jumped on and they became we was almost like one leadership team for the first 12 months. And they helped introduce me to an amazing group of people who became the first leadership team of the company. People like Pete Chen, who became our president, Erica Anderman, Lee Zucker, Rick Pereira, who became our head of people. So there was this whole group that jumped on board, and I want to say pretty quickly, Irina, who led finance. So pretty quickly, the business went from just being somewhat immature to a more formal data sort of driven company. And once we realized what was driving the revenue, that's where we started to pour some investments. And one of those was behind product. So we hired an engineering team, and the other was around sales. And so we hired some sales leaders pretty early on. One of those people who's actually our head of sales now, Jen Berger, jumped on board, and she was just incredible and so instrumental in getting the Slice message out to more pizza shops on a national scale.
That's amazing. So it looks like now, fast forward maybe 2 years or a little bit less, you ended up raising a Series A round or another chunk of capital from another venture capital firm. So what did maybe happen between those two rounds to make you think, look, we've hit this inflection point? Maybe what did growth look like at that point, and why raise even more money?
Again, one of those first people that I was introduced to is Ben Sun from Primary Ventures. As we started to ramp up in terms of resources in the company in order to make sure we put together a real team to scale, it became clear that we needed more capital ahead of the revenue we were generating. In the summer of 2016, I didn't actually go and run a fundraising process. Ben approached me and said, hey, would love to do something here. And that's when we raised $3 million. I want to say it's $3 million. Yeah, there's about $3 million, almost all of it led by Primary Ventures and Ben Sun. And so that was more formal round, I guess. Okay. It'd be more equivalent to the seed than the first round.
Got it. So perhaps it was a pre-seed round, let's say the first million, maybe a seed round, since it was second money and led by Primary. And then I had written down, I think it was Series B. Is that the 15 million from GGV? So that was the third.
Correct. And so we launched as Slice in October of 2016. We ended up launching our second product, which was a direct-to-consumer app. So a lot of consumers, think of Slice as sort of this marketplace for pizza shops, although that's one small fraction of our business. And so as the business started to really continue to accelerate, I want to say in May of 2017, we did what was then called a B round, and that was led by GGV Capital. Today, they're known as Notable Capital, an amazing group of investors and partners who have been just as key to the growth of Slice since then. But that was in May of 2017.
Things about raising that are not obvious are a lot of the terms, right? Like whether you're raising on a safe or you're doing a price round and thinking about dilution. Like, where were you getting educated on all this as it was happening?
Yeah, so this goes back to that first group of people that jumped on, that were so active and brought over their experience. One of the people that they introduced me to very early on was just an awesome human in Ward Breeze. His name is Ward Breeze. He was a partner at Gunderson Detmer, which is a law firm, counsel. Ward is actually now at...
Is he at Addition?
At Addition, yeah.
Yes, I was like, that sounds familiar.
Yeah. Ward is incredible. He was literally next to me at every moment during those fundraising opportunities. He would just provide me with such clear guidance as to what the terms meant, what it meant for dilution, what it meant for future potential dilution, what it meant for setting, what kind of expectations we were setting for future investors. And so almost at every step of the way, we just basically, I made sure to prioritize incredibly clean terms. I guess all of our rounds were just pretty straightforward. They were priced rounds, very fair prices to both the investor and Slice. And what I prioritized was clean terms. So we've never done any crazy liquidation preferences or everything's been pretty straightforward. In exchange, I didn't, always maximize the potential valuation of the company, but that's okay. I think playing the long game was really the biggest piece of feedback that I got.
Yes, I agree with that. And did you have, even back to that first million, any friends, family, angel investors come in, or did you just run a tight process with a few folks?
We had some angels come in. Couple of friends jumped on, but it was like small, tiny check. It was more of a, who's the actual investor, and just bring them on board and go from there. It wasn't so much about like needing capital as much as it was find the right people and use capital as a way to get them involved.
So let's jump now to 2020. I'm curious to hear how the business grew, or perhaps didn't. I believe it did, definitely during COVID. That you had raised $43 million from KKR. What had happened up until that point? Maybe like, did you have several product offerings beyond this initial kind of like website, like Shopify-like experience? And what was going on in 2020 to lead you to raise such a large round?
Yeah, this one was a very specific reason, but by that point, the platform play started to become a little bit more real. We had just acquired a small point of sale company, so we were starting to go more, think about more sort of vertical integration to realize that what I call reverse franchise model. But what led to the round in 2020 is COVID was kind of just happening. We had a pretty healthy balance sheet, but it wasn't like, crazy balance sheet. Stay-at-home orders go into place. And Jeff Richards from Notable Capital calls me and says, hey, we have these partners in Asia, kind of see what's happening there. This is not just going to be like a 2-week thing. I'm afraid, and unfortunately, this will be a very long-term thing. And what we're seeing there is just this huge ramp in demand for takeout and delivery, which is the core business model of our customers, the pizza shops. And so instead of playing defense, we need to play offense. So instead of like cutting costs, we need to invest. And in order to do that, who in your network do you know who can jump on with us and put some capital behind the business? Over the last 4 or 5 years, I had spent a good amount of time with Jake Heller at KKR Growth, who was before that at a fund called Spectrum. And he had written a really thoughtful email to me on January of 2020, just to sort of articulate his desire to work with Slice at some point. And so I gave him a call. It was middle of March. And I said, hey, Jake, here's what's happening. I know it's a crazy time to ask for money because all businesses are basically going to zero for a couple of weeks. Here's what I believe will happen. Now's the time to partner. And KKR jumped on. And that's how the $43 million round came to be. Within a couple of days, we got a term sheet, super clean term sheet. Things got a lot worse for the next month, but KKR and Jake, they didn't budge.
Wow.
They stayed committed to the initial terms that they offered. So we brought on $43 million, and that really helped fuel the next, call it 24 months of the business, especially as that COVID tailwind came into play. So it was really Jeff coming on board and saying, we need to play offense. Here's what we're seeing. So that experience coming into play. And then the conviction from Jake at KKR, and here we are.
Yeah. So you are rare in that you went to market already having 40 million in GMV to raise capital. It looks like over 200K a month, in revenue, or at least like just cash flow. Were there investors that you met that didn't want to invest? Like, did people ever pass? Walk me through that.
Yeah. So this was the lesson I learned after the 2017 round. So we raised 15 million. It was really our first big round. And I think we got a little bit too loose with spend between 2017 and 2018 and 2019. So when it was time for us to raise our next round, which would have been our C round, I could not raise my C round for the life of me. And that's because we set some real expectations, which I wasn't aware of, or I was, but I didn't really take serious enough. When we raised the 15 million round in 2017, the expectation was that by 2018, the business would be at least 2x plus. Otherwise, venture doesn't get as excited. Right. And we didn't do that. We grew, but we didn't grow by, 200%. And I also, because we got very scattered, it was a lot more challenging for me to speak about what we did with capital and the story just wasn't there. Yeah, I just couldn't raise any money. But what happened is GGV, which is notable, Jeff Richards jumped on, led the round, and we ended up putting a round together in early 2019, which was, I want to say 25 million. And that was kind of like a B1 or whatever you want to call it. But it was almost like an extension to the B. That was the year that I just could not raise money. Like I just couldn't do it.
That's interesting. Yeah, I think it's not a natural muscle for people to grow and scale a company so quickly and keep track of all the checks and balances. Is obviously learn the first time that you're doing it. And then obviously, I think in some ways, VC is a forcing function if you have great investors to keep you kind of board meeting ready, if you will, like where you're always prepared to have like quarterly updates. The financials are tight and you understand what like, okay, at this stage in our revenue and how much we've raised, like here's the accurate monthly burn that makes sense for a business. And a lot of that you might just not have, if you don't come from the network or aren't really that close with a lot of investors who have expectations.
Yeah, and we had a lot of that. I want to say what I didn't learn soon enough was that the next round of investors that were going to come in also had expectations of outcomes. I don't think I understood that well enough. It was challenging to sort of tell the story of the future. I want to say in too many ways, very like near-term focused. So I want to say that was one challenge. And the other is like every entrepreneur should know this is when you sign on for a round, X amount of dollars at Y amount valuation, you're setting expectations for then what you're going to achieve for the next 2 to 3 years. And if you don't, then that creates somewhat of a headwind for future fundraisers. This is why like steep valuations may be fun when they happen, but you've got to live up to those expectations moving forward. So ultimately, if you think you got away with like a very high valuation in one round, I almost can guarantee that at some point it's going to balance itself anyway, because the next one will be more challenging. Aside from like 0.001% of companies that are just like perpetual rocket ships with perfect product market fit.
Very rare.
Yeah, exactly.
I invest at pre-seed and seed, and so it's hard to tell founders who are raising their first round of capital. They might have multiple term sheets, but I have yet to see a seed round done with nothing, by the way. It could be a pre-seed. They're just raising a lot of capital, like over 3 million. But they'll raise 5 million on 30 posts, and then 24 months later, they have like almost no money left. They don't really have a product because, as you said earlier, it creates this like forcing function to get things done or die when you have a limited capital, right? Those constraints are really important. And so founders always take the highest term sheet when they raise the first round of capital, and then they're humbled, by the next one. So it's hard to tell people that, they have to go through it. But I love that you're saying that after all of the rounds that you've done at the scale that you guys are at.
Yeah, definitely. I mean, my advice would be to take just enough money that you believe with a little bit of a cushion that you believe will get you to the next milestone with a fair valuation. This way you have optionality at the next round. That's I think the biggest lesson. It's like if you end up finding yourself in the need for capital by the next round and you have no options, then you're gonna get diluted anyway or lose the company.
Yeah. Wonderful. So I know we only have a few minutes left here, and you did raise another round of funding in 2021. I wanted to quickly, it sounds like maybe the business has been smooth sailing. Was that the last round of funding? And then I want to jump to a couple fire questions if we have enough time.
Along my journey, I've met two awesome people in Adam Bain and Dick Costello. They have a fund called O1 Advisors. They passed on Slice during that year that I couldn't fundraise. Not their fault. It was my fault. And so, but as the business continued to do well, stayed in touch with Adam, and he's like, hey, we're raising our next fund. I hate that I have to keep saying that, we let Slice sort of pass away or slip away. And I just want to get involved. Happy to do a 10 million check with an uncapped note, anything, just please take this money. And so this was in March of 2021. Mm-hmm. So in order to get them on board, all the insiders decided to participate as well. And so we put together a 40 million round, basically led by O1 Advisors and insiders like Cross Creek, GGV, which is now Notable, Primary, KKR. And yeah, that was more of a just to give people an opportunity to come on board, strengthen the balance sheet, but we have actually yet to even use that capital. We've been profitable since 21, and so just the need for fundraising hasn't been there.
Yeah. Dick is actually probably the best person I've met this year, and would like to call him a friend at this point. And he is just a delightful human being. So I love to hear that. I know we pretty much have a hard stop here. I was going to ask you, like, overall takeaways or bases we didn't cover for just founder advice, right? As they're trying to get something off the ground and like probably going through it. Like, what are I know you covered a few, but any final words?
In the earliest stages, focus is so important. The analogy I'll give for my experience, and I can only share my experience, by the way. I'm not saying this is the right way or wrong way, but for 6 years, all I had was a very basic cookie cutter website product with an online ordering module, basically. And all we did was we sold that to as many pizza shops as we could. And we had that priced in a way that was really fair for them and for us. And for 6 years, that's all we did. Certainly would have loved to have done and built a point of sale earlier on, or build, bunch of other products that we've launched since, but you only have an opportunity to do one thing really well. And the capital you raise should be funding that thing. Once that works and once you have product market fit there, then you should start thinking about what are, the second and third products. But I would say that's the one piece of advice I can give, and I try to give as much as possible, which is you've got to just focus. And I think people have the wrong definition of what that actually means. I would say when you believe you're focused enough, focus some more. That would be my advice.
Yeah, no, it's easy to get distracted. Even for me in VC, I'm like, should I be doing more and thinking about more categories? Ilir, thank you so much. For next time, I want to dig into pizza. We talked nothing about it. I want your hot takes on independent versus franchise. And there's this new wave of companies, which you probably know, that are startups doing amazing in areas like med spas, nurse practitioners, in the business in a box space. So kind of bringing your world back full circle. I have no idea if you're already doing this, but where you take, you have 25%. It's a franchise model essentially, but as a startup, but maybe next time. So thank you so much.
Thank you so much.
Earlier this year, I was in a pinch. I was hiring my first full-time hire and didn't have payroll set up. I posted a quick message on X asking for the best company to help me get up and running, and everyone quickly recommended Warp. Within a few hours, I was up and running with payroll and benefits and able to onboard my team. Warp is one of the few platforms that allows you to offer healthcare with a minimum of 2 employees. It has coverage across 50 states, manages all state tax compliance, offers health and 401k benefits, and with no strings attached. For a limited time, get a free AirPods 4 when you click the link below in the show notes to learn more about Warp. It's difficult to find the right banking partner. I was very fortunate to find Stifel Bank. Stifel's venture banking team is your trusted partner for a full range of banking solutions for both venture-backed companies and venture funds. Stifel Venture Banking supports seed through late-stage companies, providing solutions for treasury management, strategic lending, and tailored banking offerings. Check out stifelventurebanking.com to see how they can help you reach new heights. Stifel Venture Banking is a division of Stifel Bank, member FDIC. You can find the link below in show notes.